I basically believe that the stock market is efficient, which means all publicly available information is constantly and instantly being priced into every stock. By buying an individual stock, all you're doing is basically exposing yourself to greater risk and volatility without a greater expected return. And when you're accepting more risk for the same expected return in investing, that's a bad trade. You don't want more risk for the same return. You want less risk, all things equal. And so that's where an index fund comes in. Since the market's efficient and all prices are efficient, or all stocks are efficiently priced, just buy all the stocks, therefore mitigating your risk to as small as it can be, because you've diversified away all risk of owning individual stocks. And then you've guaranteed yourself your fair share of the growth of the entire stock market. That's why I buy index funds. When I started investing for the first time, I was actually 17 years old, and I was working at a summer camp. And my dad cleverly saw that I had taxable earned income for the first time. And so he opened a Roth IRA, and then we picked some mutual funds. I think we picked the Fidelity Fund, as it was called, and the Fidelity Contra Fund, which actually turns out to be a great fund. Kind of in college, in my early 20s, I did some, dumb stock picking stuff where E-Trade was the Robinhood of the day. And so I opened up an E-Trade account and it was just throwing spaghetti against the wall, buying and selling random stocks without really any serious rhyme or reason. And then when I was 35, or when I sold my company, I had this windfall, and my investments had grown to that point to about $120,000 just from living on $36,000 a year and investing a normal amount. But I had this windfall from selling my company, and I started reading every single book I could on investing and personal finance. And I realized they all say the exact same thing, that optimal investing is buying and holding low cost index funds. And that's when I bought kind of this portfolio of the 5 or 6 ETFs. And then as I continued to learn even more, I decided that even that was too complex, and the target date index fund is actually truly the most optimal, simple, low cost investment strategy. When you invest, there's only so many different asset classes in which you can invest. US stocks is one, non-US stocks is one, bonds is another. And so those three kind of make up a 3-fund portfolio. And so if you were trying to invest very simply, you could buy 3 exact things, a US stock index fund, an international stock index fund, and a bond fund. And then you would buy those in proportion to your age. So for example, if you're very young, you have a very long investing time frame, bonds aren't that important because bonds provide income and stability, but you don't really need those things when you're young and building wealth. So you'd have a portfolio of 90% stocks or more and 10% bonds or less. But then when you're very old or after retirement, then things have kind of switched, where now you don't really care about long-term growth, you more care about capital preservation. And so you want maybe 50, 60, or 70% bonds and 30% stocks. So a target date index fund is saying, hey, this is basically common sense, optimal investing. We'll do that whole process, choose those funds automatically, and then reallocate them as you age automatically. And that's a target date index fund. And so instead of buying those 3 index funds in the proportions based on your age and rebalancing and reallocating over time, you can buy a single package called a target date index fund, which has those things inside. And then, it sets the asset allocation based on your age. So diversification is very important, but I think people often confuse having more funds with being more diversified. So for example, you could buy a Vanguard S&P 500 index fund, and you could buy a Fidelity S&P 500 index fund. I could list 20 ticker symbols, and you could buy all those things. But inside of those ticker symbols, they're all the exact same thing. And so you're actually not very diversified at all. You basically only own I shouldn't say not diversified, you own a lot of stocks, but you basically only own large US stocks. So I could make one portfolio with 20 different ticker symbols that owns virtually the exact same thing, or you could buy one target date index fund that is dramatically more diversified. Instead of holding the same 500 stocks, it holds tens of thousands of stocks, large US, small US, international, and bonds. And so diversification is important, but it's not to be measured by how many funds you own. It's to be measured by like what's going on inside those funds.